If you spend any amount of time on social media, you've probably heard about whole life, universal life, variable universal life, or index universal life insurance policies. And these policies come in very different names. They're all basically the same exact thing. Absolute crap. And in my opinion, I think they're some of the most terrible options when it comes to life insurance policies that you could sign up for a whole multitude of reasons. So let's go over some of those specific reasons why I think these policies are so bad and why I think that most people should stay away from these policies. And we'll talk about alternative way to buy life insurance. So let's first start with talking about what life insurance is. The purpose of life insurance is to protect anyone who depends on your salary in the case that you pass away. So for example, let's say you're married and you make $200,000 a year and your spouse makes $50,000 a year. Generally speaking, if let's just say for whatever reason you were to not be on earth anymore, you would probably make it hard for your spouse to continue the same standard of living that they have currently. So the purpose of life insurance is to be able to fill in that hole that is caused by your lost income in case you were to not be able to earn an income anymore because you passed away. So the person who would receive that money once you pass away is called a beneficiary, and they would receive something called a death benefit, which is pretty much the amount that your policy is worth. So if you take out $1 million life insurance policy, then your death benefit that the beneficiary would get is $1 million. And the beneficiary could literally be anyone. It could be an actual person, it could be a trust, it could be a corporation. And you might think to yourself, why does a corporation need a life insurance policy? Well, a lot of corporations depend strongly on their founder CEOs. For example, Jeff Bezos, when Amazon was on their massive come up during the early 2000s. And in those cases, sometimes companies will buy life insurance policies just in case the founder was to pass away or something like that, to kind of fill in the gaps while they try reshuffle. But anyways, that's the basics of what life insurance is. So now let's get a little bit more in depth and talk about universal life insurance or whole life insurance. So in this video, you'll probably hear me use the two terms interchangeably. And it's because for the most part, they're almost exactly the same product. Really, the big difference between whole life insurance and universal life insurance is that universal life insurance tends to be a little bit more flexible on the premiums you pay and how much coverage you have, whereas whole life is usually pretty fixed from the moment you sign up for the policy. So let's talk about what universal life insurance or whole life insurance really is. And essentially what it is that it's what's considered to be a permanent life insurance, meaning that it does last for the entirety of your life as long as the policy is kept enforced and does not lapse. So there's two parts to it. There's the death benefit and there's the cash value. So death benefit is what your beneficiary will get paid in the case they were to lose their loved one. And like I said, with universal and whole life insurance, they basically last your entire life as long as you continue paying that premium. There's also a cash value part of it where you could put money into your insurance and use that money to either get a guaranteed return through a whole life policy, or if you have a universal policy, you could get a variable rate of return that may be tied to some index like the S&P 500 or NASDAQ or some other index out there. And with the cash value account, it's very similar to a 401k where you could put money in there on a tax deferral basis. So you don't pay tax on the money you put in. Then the money that you take out of it, you do pay taxes on. And these two parts make up how much you pay for your total premium. So you have one part of your premium that you're paying just solely for death benefit, kind of like if you had a term life insurance policy. Then you have an additional part where it's a cash value premium that adds to the cash value of your policy. So now since we've broken down what life insurance is and what universal and whole life insurance is, let's talk about some of the problems that I personally see with these universal or whole life insurance policies. The first biggest problem I see is that the fees that you pay on these policies are typically what they call front-loaded, which means that the first dollars you contribute into this account are used to solely just pay fees. Typically with these accounts, your policy will be enforced. So once you sign up for it and you're approved, Your policy will be enforced, so if anything happens, you'll get paid out. So that's the death benefit side of the policy. The cash value side of the policy, usually you're spending the first couple years just simply paying the fees that come with that account. So it may take you about, in some cases I've seen anywhere from like 3 to 6 years just to get to a point where you're actually putting money in to invest. 35-year working window, 3 years is like almost 10% of that window. So it's a pretty significant time to be just paying fees. Also, because the fees are front loaded, you're also using the most valuable dollars that you're going to put into that account to just simply pay someone's commission. Now, another problem with these accounts is that when you pass away, your beneficiary doesn't get both the cash benefit that you've been contributing to and the death benefit as well. Usually you only get paid out the death benefit and the insurance company keeps the cash benefit. To me, in my opinion, like that is basically this highway robbery. And this, I think, is probably the biggest reason why I personally believe that nobody should ever have these policies, because what is the point of you putting all this money into this account only for the insurance company to take the money if you pass away? It doesn't make any sense. But let's hold off on that and we'll talk about that more later on in this video. And an alternative to that. So when it comes to universal index policies, there's another thing about these policies that I really don't like. And these are the ones that have really been popping off on social media recently. So usually what will happen with your cash value account is that account will usually be, the money in it will be taken and invested into like the S&P 500, for example. And your returns will be what I like to call bracketed. I think there's a more official term for this, but essentially what happens is that they'll put a cap and a floor on how much your return is. So they might say like, hey, like if the S&P has a down year, the most you'll lose is 2%. But if it has a positive year, the most you'll earn is 12%. And you might think to yourself, well, how can I lose if that's the case? Well, I actually did some research and I looked back from 2023 all the way to 2003 and looked at the returns as if this cap was in place versus if you were just to invest and go with the full ride of the market. So if it went up, it went up. If it went down, it went down. There's no cap. There's no floor. You weren't protected at all. And when I looked over that 20-year span, your return with the cap and the floor would have been somewhere around 461%. So that means you put in $1, you get $4.61 back. Now, if you were to invest without those caps, you would actually get, for every $1 invested, you get $5.13 back on your investment, which leads to a bigger gain. So even though you had this quote unquote protection, you still end up getting a better return overall. One of the biggest dangers you have in investing is you invest in money and not getting your maximum return. I think, I forgot what the stat is, but it's something like if you miss the top 10 days in the past 10 years to invest, your average return goes down from 7% down to like 3% or something like that. So really missing the high ends, missing that like 30, 40% gain years because you're capped at 12 really can do some significant damage to your returns in the long run. Expand more on my thoughts on these products is that first thing, I think they're very complicated to understand. I'm a licensed financial advisor, and even sometimes some of these products really confuse me. So I can't even imagine like the typical person who doesn't really understand finance or insurance very well to understand these products either. And in my opinion, anytime there's something in finance that's very confusing to the consumer, that automatically puts up a red flag for me. Now, I know some tax strategies and whatnot can be legal and very confusing, but really most of the things that 95% of people will be exposed to should be very simple to understand. And you really shouldn't be putting your money in something that you don't understand. So if it takes you like a month to figure something out, then you need to spend that month figuring it out. Like you shouldn't just go invest in it because someone told you, oh, this would be a good idea. Like even for me, like when I talk to family and friends, like, yeah, I might understand something better than they do, but they should still understand it as well, because it is very important that they understand what the objective is, why they're invested in this, what's the goal outcome. To add on that as well, I believe that life insurance, the purpose of life insurance is to protect in the case of possible loss of life. And I don't think that that should be mixed up with the purpose of investing, which investing is designed to protect your lifestyle once you're past your working years. Like I said, mostly because if you were to pass away, you would only get your death benefit and you lose your cash benefit. So if you go and you YOLO your 401k and you say, nope, I'm not putting money in my 401k, I'm just going to put money in this life insurance policy, you might be kissing away your nest egg. And if you were to pass away and your spouse was to stay around, that could really mess up their retirement plans. I'm just going to be frank. I think that's almost unethical to even sell this product if you actually understand what it does and how it operates, because you're basically just stealing money from people. Another thought as well that I'd like to share is that insurance companies have stood the test of time. I think the oldest insurance company that is still in business right now started in like 1751 or something like that. So a lot of these insurance companies have survived famines, pandemics, major market crashes, multiple world wars, and they're still around. And the reason why they are is because anytime they write a policy, they don't lose money. Like, you have to understand that insurance is basically just a giant game of math. And these insurance companies don't lose money. Every time they issue a policy, they know they're going to make some money from it. And if they don't, then guess what? They'll just raise the premiums. That's exactly what happened after the end of COVID when inflation went crazy. A lot of these insurance companies also went, okay, we're just going to raise our premiums because we need to make sure that we're still making money. And that's exactly what they do. So what do I think is the best alternative to buying a whole life insurance policy? Like I said, because I believe that life insurance is designed to protect your loved ones in the case that you were to pass away and they depend on your income currently, I believe that you should have a term life insurance policy to cover whatever term needs to be covered. So, there's a multitude of different ways to kind of think about this. Some people think about their total debt load and they just get a life insurance policy to cover their entire debt load. So if they're passed away tomorrow, their spouse could just wake up, pay off all the debt and be debt free, and then just live off their income. There's so many different ways to think about that, and that would really require digging into your personal financial situation. But as just generalized advice, I would say that really you should have a term life insurance policy. And then when you save for retirement or when you're just saving, you should do that in Roth IRAs, 401ks, health savings accounts, or even individual taxable stock market accounts. I think that's the best financial path forward for your entire family, and not just giving your money to these insurance companies so that they could take your cash value when you pass away and basically just rob your family of the wealth that you have been building. So I don't know. That's just my 2 cents. Thank you guys. And that's all I got for you guys. Thank you so much for watching. As always, please like, share, and subscribe. If you have any questions for me, let me know down in the comment section. I'd love to hear from you guys. And I'll see you in the next video. Peace.